So the point I'm trying to make, and I've been trying to make for the last 4 years, having focused on this research here with venture capital investors, is that what they do in the world matters very much. Lots of the research, particularly around tech ethics, is focusing on what people call artificial intelligence, AI, and the various different substrands of that. And what I've been focusing on is how these people even come about, right? Because people like Mark Zuckerberg are influenced and financed, most importantly, and that finance comes with power by VC investors like that guy here on the right, who's Reid Hoffman. And I briefly want to take you through some of the ideas that you quite quickly figure out these VCs follow, and what kind of a difference that makes when it comes to any tech company, right? So in a sense, again, the argument I'm trying to make is that we need to be much, much more careful and scrutinize these VC investors much more, because they're upstream and they influence everything that comes downstream, including AI, but including all the other tech that we are living with on a day-to-day basis. So who are these VCs to begin with? I call them the kingmakers for exactly that reason that I just laid out. They make all of these tech, big tech and small tech alike, that we are living with on a day-to-day basis. The platform that we're using here was financed by several dozen millions of VC investments only over the last 18 months. Zoom, the equivalent of that, was heavily financed by VC investors over the last 6 years. Lyft, all of these examples that we're using on a day-to-day basis. The problem being, and one reason why they're not very much looked at, is it's a tiny industry to begin with if you're just looking at the numbers. Just about 150 billion invested in 2020 compared to 9,000 deals or 20,000 globally, which is, compared to any kind of GDP figure or any other investment type, just not an awful lot. That means economists are not particularly interested in it, and they're playing this tiny little piece of they're a small cog in a massive system to a certain extent. But then actually their influence is completely outsized, right? 7 out of the most valued companies worldwide, including Facebook, Google, Amazon, are originally venture capital backed. And what that also means is board members, and particularly early board members, the people that really shape the culture in these places, were venture capital investors. So again, who these people are and what they do matters immensely in order to understand any kind of technology company and how it's set up in its mission and values. And very, very simply speaking, which might not be easy to judge from this graph, is an understanding of what structures these VCs, or what they're called as well, general partners or GPs, are part of. I just want to point out 2 very important things. One is they're not investing their own money, mostly not. They often have what is called a commitment to make into their own funds, but they're investing so-called limited partners money, LPs money, and they could be anything from a foundation in the US like the Mellon Foundation, which is very, very big, invested in venture capital, big endowments. All of the big university endowments in the US have big allocations in VC as well. 2, in Europe in particular, state funds like the European Investment Fund, which is one of the biggest limited partners in venture capital worldwide. And then smaller entities like family offices, high net worth individuals, or another big player in the European ecosystem is fund of fund managers. So in other words, they're really investing all of our money into these technology startups, right? And they're operating in a world that's very much shaped by other VCs who are competing with these investors to get into the quote unquote best deals. And that's important to understand for what I'm getting into in a second, namely what I call their ethics, which is very much going back to an Aristotelian notion of what that might mean. So I don't really care about a normative understanding of good and bad. I care about why do these people do what they do in the world, with what goals in mind, right? What is the kind of good investment, Aristotle called it good life, that these investors are imagining and striving towards, and what it means for them to get there. And again, this is heavily influenced by the other VCs. But the bottom line is not totally surprising. What these people are trying to do, going back to the structure that I just laid out, they're not investing their own money, they're investing other people's money, is really make more money. I did somewhere between 400 and 500 interviews with VCs. I spent 6 months in Silicon Valley. I live in London, so I'm in and out of the ecosystem here, and I spent 2 summers in Berlin. So I'm trying to do what you could call a multi-modal ethnography in the Western venture capital ecosystem. And quotes like this I encounter on a day-to-day basis. Right? Venture capital really is about money. It's a risky asset class. 9 out of 10 startups don't really return any big return on investment. So most of the VC funds actually have a very hard time making anything above market rate returns. But if you're hitting it big, right? An Uber investment or an Amazon investment or a Google investment made many people billionaires along the way in that investment chain. And that's what he really is in for his LPs here. Sam, this VC partner I met in London, all names obviously are anonymized. I interviewed in 2019 and have met several times since. It's about generating these biggest possible returns, right? That's really the bottom line. That's what we see as financial investors are doing. Now, there's a certain challenge to what you could call the VC model of the last century that's focused on, or the last decade, or the last 20 years, that's focused on this mythical animal here in the middle. And let me just say one word before I'm diving into ESG for the last 2-3 minutes here, about these unicorns, right? The VC model that we've been seeing playing out over the last decade or so was something you could call blitzscaling unicorns. So very much pumping money into these startup companies, scaling them as fast as possible, rolling them out into different countries in order to generate these unicorns, i.e. startups that are valued at more than £1 billion, to then sell them either to a buyer or through an initial public offering to the public markets. At which point the VCs can take out their money and pay back their LPs and get 20% of the profits that they made. That was ultimately the bottom line. And all of this happened, remember what I said in the beginning, it's very important that these VCs operate in this market together in competition with venture capital investors that are, on the one hand, following each other. There's very famous ones that everyone wants to be in a deal with, but also pushing each other out because these deals are reasonably competitive. So that's the kind of starting point that I went into this field with to explore what's happening now, right? And without going too deep into the details here, there's many much bigger narratives that have changed over the last 4 years when it comes to stakeholder capitalism, when it comes to different kinds of doing capitalism as well as investment. And the one that is starting to really impact the VCs is ESG, right? And particularly ESG metrics. They're starting to, in their due diligence process, so when deciding to invest in a company, as well as in their portfolio management, so once they are investors, helping these companies to grow, think slightly more sustainable, think slightly more longer term, and slightly less about how can I grow this company as quickly as possible into a unicorn and then sell it, and then I don't really care about any unintended consequences, any societal impact that a company like Uber or Facebook or Airbnb might have. So there's what I'm very much exploring right now, live as it were, as this is something that's only starting recently, is this top left bucket here. How do VCs imply and use ESG? The problem which you might or might not have encountered, which I want to close with here, while I am hopeful that what I'm observing at the moment is really a shift in the industry towards rethinking this blitzscaling unicorns ethics into something that you could call looking for sustainable disruption, if that is something that exists. What we're going to struggle with is it's very unclear what ESG even means. This is to end the and really start a conversation, but to end the presentation. This is a a very interesting project that looks at public market ESG ratings. So the public markets are slightly ahead in this game. They think they figured out how to rate ESG, so really metricize it properly and put it into numbers. And this project is aptly called Aggregate Confusion, coming out of MIT. And what they look at, if you're just focusing here on the Apple, on the top left here, is different rating agencies rating Apple according to its ESG profile. And it's all over the place, right? One rating agency thinks ESG at Apple is very well done. Another one thinks it's very badly done. So we are running into trouble here, even where data is easily available, where the companies are mature, and there's basically a problem even in the public markets when it comes to really thinking through what this sustainability and ESG might mean. So I'm hopeful, but also wary that this is something which is even going to be more complicated with my VC investors. So looking forward to exploring this in the next 3 years.